So a pretty tough week for equity markets, particularly developed market equities, and that's because of central banks and the governors have been speaking this week. So Draghi and Carney have been moderately altering their tone to a more hawkish tone that started to talk about potentially tightening monetary policy and raising rates at some stage. And that's had quite a big effect on the bond market. So we've seen yields in the Bund, German 10-year Bund, and the UK 10-year gilt rise quite significantly in terms of percentages this week. And that's fed also into stock markets and currencies. And here we've got the pound, which has been pretty strong against the dollar. So in terms of that cable rate since the start of the year, sterling's gone from around 123 to 130. That move has been precipitated by quite a big shift in the probability of a rate rise before November 2017. So here, a couple of weeks ago, we're looking at a pretty much zero chance of a rate rise. Now it's up at 60%. So that big shift, that inflection has shifted the currency. It's also shifted the bond market, which has moved the equity market as well. The reason for that sensitivity, because it is merely a sort of nod towards the potential for rates to rise at some stage, is because of where we are in the longer term rate of interest rates around the world and bond yields around the world. So here we've got the longer term chart of the US 10-year Treasury going back to 1962, and as you can see, it's been a pretty straight line down from 16% at the start of the 80s down to where we are around 2% on the US Treasury yield. Now, clearly, certain sectors will benefit from rates going up, and we've talked a lot about financials being really important within the context of a portfolio for offering protection against the normalization of that yield curve. And here this week we've got a real clear indication of that. So as central banks have started to intimate faster tightening, you've started to see outperformance within financials. This week was exaggerated because we got the results of the CCAR, which will allow these large US financials to pay back over 100% of their earnings, and that's sort of symptomatic of a loosening in regulation in US financials, which is really the first official time since 2007. So it's a big event for the sector. But the sector performance this week belies a bigger trend. So firstly, the areas of the market that were outperforming as rates go up are the value parts of the market, so you need to be weighted in those parts of the area of the market to offset the declines that we've seen in those either dividend or bond proxies, which tend to be the defensives like telecoms or utilities or healthcare, and also the tech stocks, which because of their earnings are a long way out, that they're very sensitive to the discount rate or the interest rate when you look at the present value of earnings. Looking at the week ahead, in terms of macro, it's going to be relatively busy. So we've got a lot of sentiment data coming through. Those sentiment data are still expected to be pretty positive. So a lot of these results coming in above 50, which show expansion, people becoming more positive. The rate of positivity has declined a bit. So you've seen some of those numbers miss economist expectations, but it's still an upward trajectory. In terms of the results next week, again, it's another light results week. We've got Imagination Technology, which obviously will be clearly very interesting given we're in the middle of a potential takeout there. We've got Ocado on Wednesday, again, in the midst of this sort of restructuring of the grocery sector with Amazon and their recent acquisition of Whole Foods. And then we've got Syncona, which is one of our preferred ways to invest in early stage biotech. That's it from me. Thanks very much.